at our 1250, but the same, it's just like a tenth the size of everything. Just kind of imagine everything a tenth size, go from 120 to 115, $5, and you have, let's say, 100 shares, you have $500. So it depends a little bit on the risk that you're willing to take, the amount of profit you're trying to get. ETFs are not the type of venturesome thing that you want to do if you have, wild-eyed greed in your mind, and you definitely want to go, go for the gold, and you want to get big profits in a short period of time. Now we want to switch again back to our presentation. We want to show you a little bit more about, as I mentioned, the gold ETF. Want to emphasize the fact that when you look at ETFs, as I mentioned before when we were talking about the volatility and the liquidity within the gold, in some cases that you you can see where there is some volume issues. There are some volume issues and some problems in terms of volume and volatility and other types of things where you may not want to trade those. So there are some things that are on the downside for the ETFs, and that's why you have to examine them as carefully as you. The amount of trading that is available to you, is it available to you in sufficient size and time and so forth so that you can actually feel comfortable by being able to trade? Maybe a situation here where if you have an ETF, it might be in that 80%, or this is an estimate that I have seen, that are too illiquid for the average individual trader to trade. And, probably one of the markets you might want to avoid. But so you got to examine your volume, examine the volatility of the ETF that you might be considering. When you're looking at the volatility, you have to also remember that it could be a big move that comes on bad news for a sector or some key components of a sector. There are some situations here relates, like let's say that you have a situation here, as I pointed out a couple of points down below, where you have a few dominant stocks that determine the actual level of the ETF. If there's bad news in that stock, or if that has a big influence on the whole sector, the ETF may not trade exactly like you think it ought to trade. Now, it does trade like a stock, as I mentioned, but differently than a stock for that reason. So, the influence of bad news somewhere else could affect the ETF, could affect your whole basket of stocks that you're trading. Now, one of the things that you have to look at and have to consider with the ETF is that it is still a derivative instrument. And sometimes I think that derivative instrument is kind of a four-letter word, a bad word for a lot of investors recently with some of the developments that have happened. Even with most futures transactions, of course, you do not really own anything, but you're speculating on a change in price. You're substituting a current action for a future transaction. Looking at the gold ETF, GLD, as I mentioned as an example, with all of the interest in gold and the last year or two, GLD is now supposed to be one of the largest holders of gold in the world. It's reports that it has more than 850 tons, or more than the gold reserves of Japan or most other nations. But this gold that is supposed to be in the vault somewhere, held by the custodians or sub-custodians or somewhere along the line, often it is really nothing more than a piece of paper or a certificate saying that you own this or you own that bar or a piece of a bar or whatever. So in many ways, it's a lot like a bank lending money, an insurance company's escrow account for paying claims, those kinds of things, where if someday many people demanded to withdraw their money from the bank or the insurance company had to pay a huge amount of claims all at the same time, would they really have the money to do that? Banking or insurance is a great way to make money, and where you take in a lot of money and you lend it out and you invest it and use a chunk of it to pay salaries and expenses, and you erect fancy buildings. But then you got to hope that your actuarial people are correct and that you will have enough reserves to cover any withdrawals or claims that might come against you. Sometimes it all catches up to the banks or insurance companies, as we know. They don't have enough money coming in the front door to go out the back door. You even have maybe the government maybe has to step in as fund is based on confidence. And it's not unlike the confidence that many supposedly really smart people placed in mortgage-backed securities and collateralized debt obligations. As long as that confidence remains and things go along smoothly, everything goes okay. But if there is a crack in that confidence, then things can fall apart rather quickly. I'm not saying that's the likely fate of GLD because I really have no idea how much money is really there. I suspect that probably no one else does either. But many of the banks that are involved in the gold market are in Europe, such as HSBC, which is the GLD custodian. You probably have also heard that the European banks may have more problems than even the U.S. banks with debt problems in like Greece and Portugal, Spain, elsewhere. There are several articles that I have read, including one by Van Tharp in a recent Trader Planet newsletter that just makes me wonder about some of the large ETFs and when they're based on one market like gold or silver or oil or currencies. What is the future for those? Or are we headed for another breakdown of some kind? And I'm not saying that that will happen, but it's just one of those things I think is a worst case scenario you have to keep in mind if you are thinking about investing in the ETFs like those. Read the fine print. Know what you're getting into. It's like you have to do or should be doing with most investments. Now, the opportunities that you can get with ETFs, as I mentioned, you have a wide range of actively traded choices. There's a market area on the move. It's likely there's an ETF somewhere that will fit that market. And, if there isn't one, there surely will be one soon if somebody sees an opportunity to take in some investor money and be able to use it, for their own purposes. ETFs are familiar. They're like stocks. Everybody kind of knows how they work. It's great for portfolio diversification if you want some exposure to a certain area, which could include any of the commodities. It could include currencies. You can get the diversification that you want very quickly by using an ETF. Have a lot of advantages with them in the liquidity, flexibility, cost-wise. Use them in many trading strategies. You can set up iron condors and trade against a holding that you have with options. There are many things. But again, just to reemphasize, you do know or should know what you are getting into because there are some things that you obviously have to be aware of before you trade any market, including ETFs. Thank you for attending this webinar. We were doing a series